You open an investing app on your phone, find a company you like, and tap the buy button. In that single millisecond, a massive, invisible machinery begins to move. You think you were simply buying a piece of a business, but the reality is far more complex. Now, does that button actually represent a transparent auction, or is your trade being routed through a hidden machine? Today, we are peeling back the curtain on the hidden machinery that determines the exact price of the stock on your screen. We'll see how the process moves from a simple digital click to a high-speed world of algorithms and private rooms, where the real giants of the market move in silence. Go back to the 1600s. The Dutch East India Company was a massive operation, managing hundreds of ships globally to trade in gold, porcelain, spices, and silk. But managing such a fleet was incredibly expensive. To finance these costly expeditions, the company turned to civilian citizens. Instead of taking a loan, they offered a deal. Individuals invested money in exchange for a share of the ship's profit. This created an urgent need for a place to trade these shares. Unintentionally, they invented the world's first stock exchange by selling these paper slips in European ports and coffee houses. It's almost absurd to think that a global financial system began in a coffee house. Modern exchanges are significantly more complex than their original forms. Yet the basic engine, people buying into a piece of a voyage, is exactly what we are still doing today. Let's look at how this works in practice. Imagine a woman named Maya who wants to start a sneaker store called Fresh Kicks. To get the business off the ground, Maya needs $100,000. She has half of that in savings, so she decides to divide the business into 10 equal shares. Since each share is worth $10,000, she can bring in partners to fill the gap. This is the fundamental reason why companies sell stocks: to raise capital. Whether it's for building factories, developing new products, or paying bills, selling shares is a powerful alternative to borrowing from a bank. The crucial difference is that money raised this way does not need to be paid back with interest. Take Jordan, who invests $10,000 for one share, giving him 10% ownership. Now the risk and the reward are shared. If Fresh Kicks grows in value to $300,000 after 5 years, Jordan's share is now worth $30,000, netting him a $20,000 profit. But if the business struggles and the value drops to $80,000, his share is only worth $8,000. In that case, he faces a $2,000 loss. At its core, a stock exchange, like the New York Stock Exchange or the NASDAQ, is simply a marketplace where participants buy and sell. But the chaos happens when those shares change hands. It comes down to a constant tug of war between supply and demand. When more people want to buy a stock than there are people willing to sell it, the price climbs. If a company releases a positive earnings report or a breakthrough product, buyers flood in. Because there are few sellers at the current price, the price is pushed upward. This creates a natural loop. As prices rise, the cost for subsequent buyers increases, creating a ceiling where investors begin to question if the asset is truly worth the price. If sentiment shifts and sellers suddenly outnumber buyers, the price drops until it finds a new equilibrium. It's a balanced machine, but the gear that drives it is human emotion and information. To understand why that price moves, investors look at the engine of the company, its fundamental value. The primary tool here is earnings per share, or EPS. This is a simple calculation: the company's total profit divided by the number of shares available. If a company earns $1 million and has 1 million shares, the EPS is $1. Now combine this with the price-to-earnings ratio, or PE ratio. This tells us how much investors are willing to pay for every dollar the company earns. If the stock price is $20 and the EPS is $1, the PE ratio is 20. This is essentially a bet on the future. A high PE ratio suggests the market expects massive growth, while a low one might suggest the company is undervalued or struggling. However, these numbers are the engine, but market sentiment is the weather. Even if the engine is strong, a storm of bad news or a sudden trend can blow the price in any direction. This is where the distinction between share types comes in. Common stock is the most common vehicle for these bets, offering voting rights and high growth potential, but it is the most volatile. Preferred stock, by contrast, acts more like a bond. It offers a guaranteed fixed dividend and priority payment during bankruptcy, but you trade away your vote. The price you see on your screen is the result of the engine and the weather colliding in real time. When a company grows large enough, it goes public by listing on an exchange. This is the leap from a private entity to a global asset. But the process does not start with the retail investor. A new company typically introduces itself to large investors first. These institutional giants, pension funds, hedge funds, and sovereign wealth funds, provide the essential financial support for a company's initial public offering, or IPO. Here is where the machine becomes opaque. While we see the prices on our screens, the real heavy lifting happens in the shadows. Public exchanges like the NYSE are the visible storefronts, but there are hidden layers of liquidity known as dark pools. These are private forums where the real giants move in silence. Large institutions use these pools to trade massive blocks of shares without alerting the public. If a hedge fund dumped millions of shares on a public exchange, the price would crash instantly. By using dark pools, they avoid showing their hand, executing trades in private to prevent the market from reacting before the trade is complete. To facilitate this high-speed traffic, the market relies on market makers and high-frequency trading, or HFT. Think of a market maker as the wholesaler of the stock market. They are always ready to buy or sell, ensuring that if you want to trade, there is someone on the other side of your deal. Their profit comes from the bid-ask spread, the tiny difference between the price they buy at and the price they sell at. To execute this at scale, they employ HFT algorithms. These machines scan the market and execute orders in fractions of a second. We are talking about microseconds, the time it takes for a camera flash to go off. These algorithms effectively act as the lubricators of the market, but they also mean that the price you see is often the result of machine speed calculation rather than human negotiation. This brings us to the free trade paradox. Many retail apps offer zero commission trading, yet these companies are multi-billion-dollar enterprises. How is this possible? The answer lies in payment for order flow, or PFOF. When you click that buy button, your trade is often routed to these wholesale market makers rather than directly to the public exchange. The app receives a small fee for sending your order to that specific market maker. You receive a fast execution, the app makes money, and the market maker gets to harvest data on your trading behavior. It's a system where the trade itself is the commodity, and the user, in effect, becomes the product being optimized. It is a curious arrangement. On the surface, the market is marketed as an accessible, open arena where anyone with a smartphone can participate. Beneath the surface, it is a segmented environment where the institutional players operate with a massive data and speed advantage. While the system provides incredible liquidity, one cannot help but notice the imbalance. The retail investor sees a price, but they are not seeing the full context of how that price was formed, or whose interests were prioritized in the routing of their order. To put it simply, the interface is democratic, but the infrastructure is hierarchical. To maintain order in this volatile system, exchanges employ safety valves called circuit breakers. If the market experiences an extreme drop, the trading stops entirely. For the S&P 500, these are triggered in stages. A 7% drop in the index halts trading for 15 minutes. If it falls 13%, another 15-minute halt occurs. If the market plunges by 20% in a single day, trading is suspended for the remainder of the session. These halts exist specifically to prevent panic selling, giving human beings time to process information, and preventing the algorithms from triggering a complete, unstoppable collapse. The market has evolved from a coffeehouse gathering into a sprawling, global, algorithmic machine. As liquidity increasingly moves into private dark pools and trading decisions are automated by code, we have to ask a fundamental question. Does the price flickering on your screen actually represent the collective valuation of a company? Or is it merely the optimized output of an algorithmic routing system? We have traced the journey from the Dutch East India Company's early shares to the fragmented digital landscape of today. We have moved from the simple concept of owning a slice of a business to the reality of 20% circuit breaker thresholds and high-frequency algorithms that execute trades in the blink of an eye. For the long-term investor, this infrastructure is a background concern, as historical returns have averaged around 7 to 10% annually. For the trader, however, this machinery is the primary environment. Whether you are seeking quick wins or long-term growth, the market remains a system that relies on constant movement. The question that remains, as you look at that screen, is whether the number you see is a true reflection of value, or simply the result of the machine's calculation at this very moment.